What's the investment outlook for the next 12 months? How is the outlook translated into an actionable strategy? What's the best way to embed that strategy into real portfolios? At Quintet, our approach is one of global diversification. I think the outlook for the dollar, US treasuries, is going to be key for global markets. I'm Daniele Antonucci, Chief Investment Officer at Quintet Private Bank, and this is Spot and Forward.
Dear friends of LFMA, welcome to the new episode of Spot and Forward. Today we are joined by Daniele Antonucci, Chief Investment Officer at Quintet Private Bank. With an impressive background as a former chief economist at Morgan Stanley and media commentary on CNBC and Bloomberg, we'll ask him to go beyond the headlines and share how emerging trends are truly reshaping investment strategy. Welcome to Spot and Forward, Daniele.
Thank you, Vincenzo and LFMA, and welcome to Quintet.
So we sit together in this new series titled Debunking Investment, a CIO Perspective on Emerging Trends, which includes 3 different episodes: the investment outlook and emerging trends, turning emerging trends into practical investment strategy, and last, building resilient portfolio to capture emerging trends. So Daniele, let's jump straight into the first question. You often talk about a multipolar world as one of the key emerging shifts of our time, a critical theme. What exactly does that mean, and why is it so important for investors to understand this thesis?
Thank you, Vincenzo. Such a good question to start with. So a multipolar world, if I think about it, we are shifting from a world that used to be a lot more US-centric. That means that as investors, our busiest day every month used to be a Wednesday night to figure out what the US Federal Reserve was up to with interest rates. But now we live in a less US-centric world, in a much more multipolar world, where geopolitics is a key driver. And so now we have very different actors out there, the US, China, the European Union, other important regional blocs that look at policies other than monetary policy. You could think, for example, the idea to build more self-reliance when it comes to infrastructure, when it comes to energy supplies, even defense. And these drivers are as important as monetary policy going forward. That's what a multipolar world means in a nutshell.
If we zoom out from markets and look at the macro backdrop, how is this shift to a multipolar world reshaping the economic and policy forces, such as US tariffs, that matter for investment decision?
Just as a premise, let's make no mistake, this is not just about tariffs. We have seen tariffs before with the first Trump administration. We have seen also financial tensions with extra scrutiny when it comes to foreign companies listing in the US. Then there's been supply chain tensions, attempts to mitigate or reduce availability to other countries of key technological components and also commodities. This is much more than tariffs. It's about the 2 largest world economies, the US and China, colliding in many different ways. And so when you reflect on what this means for markets, markets used to be driven by monetary policy, by the ups and downs of interest rates. Now markets are driven also by the geopolitical goals and objectives of all these different countries. So it's important to understand these drivers, and much of the research that we do at Quintet is about getting a sense of the underlying drivers that have to do with both monetary policy but also geopolitics.
Does this new global order create a more complex, regionally fragmented opportunity set, or are there areas of the world that actually stand to benefit from these emerging shifts?
So yes, we have geopolitical fragmentation, and that means that the key conviction that we have is global diversification. This is always very important. It's one of the pillars of our investment strategy and one of the key drivers behind our investment philosophy, but it's even more relevant now. And diversification plays out across very many dimensions. So the dimension number one, especially when you look at equities, means increasing exposure to a lot more regions. A wobble in one part of the portfolio could be offset by a gain in another part of the portfolio. Different asset classes is another example. We come from a world prior to the pandemic where inflation was near zero, sometimes negative. Interest rates also were near zero, also negative. But now bonds offer a good yield and attractive carry rate of return for an acceptable, in fact, a compelling risk. And so we also diversify between equities and fixed income assets. And finally, the role of commodities, the role of alternatives, from gold to liquid alternatives, private markets, is another way to think about diversification.
Translating all this into the world of equities, what's your take both near term and thinking about AI over the longer horizon? Are we seeing a structural repricing or just a cyclical noise?
Well, we're seeing both a structural change, but also seeing valuations playing out in the near term. Let me explain both. First of all, US equities remain a compelling asset class at longer horizons. It's a high quality, very liquid market, heavily exposed to the artificial intelligence and other technological trends that you mentioned, Vincenzo, and also with a significant ability to commercialize those trends. But valuations, when it comes to US equities, are on the demanding side. So we need to think about diversification and also what the valuation signal is telling us. And valuation suggests that we have been going through an unprecedented period where one country, the US, one sector, technology, just a few companies dominated US equities. Now we want to diversify away from that, retain a healthy, substantial exposure to US equities in an absolute sense, but diversify away from technology into sectors other than technology, financials, industrials, that are more attractively valued within the US and could benefit from US policies. Think about fiscal stimulus, for example. Think about financial deregulation, to give you another example. But also, earlier, a few months ago, we diversified from the US into Europe. Defense spending, infrastructure spending, these are positive catalysts and valuations are more reasonable, more attractive. Japan could be another example. There's a structural story there. The corporate governance reforms, earnings growth is solid. The yen might be appreciating, but here's another divergence. The Bank of Japan is hiking interest rates. Most other central banks are cutting interest rates. We might get a moderate appreciation of the yen, and so when translated into euros, we might benefit from that. And finally, within equities, I think also exposure to emerging markets, they are underrepresented, especially from a strategic point of view, and investors should look at those areas as well.
On the fixed income side, how does this environment shape your thinking about the credit spectrum, from sovereign debt to high yield? Where do you see risks and rewards? And can you share your perspective on debt sustainability in the US and the impact on treasuries?
A very important question. Maybe I'll make a premise here too. Fixed income used to behave very, very differently prior to the pandemic. Interest rates were near zero. And so lots of fixed income assets behaved more like equities. You cannot go much below zero when you think about it. So they were not particularly attractive. But now, because of the inflation spike following the pandemic, we shifted from several trillions of negative yielding debt into no negative yielding debt anymore. That's a sea change. It's very, very important. And so the observation number one is that fixed income now can and should be part of a portfolio. It offers good diversification, as I mentioned before, and also it offers a ballast. It helps defend, protect the portfolio when equities underperform. Now, we are quality investors. We prefer high-quality fixed income assets. In particular, we like European short-dated government bonds. It's a defensive asset. You can lock in quite a good rate of return for a low risk, and it's short-dated because we don't want to get exposure to interest rate and inflation volatility. And obviously, you mentioned treasuries. That's very, very important as well. When we think about the US, debt sustainability, the sheer size of government debt now is a key risk for global markets. So we are underweight US treasuries. We want to have a reduced exposure to treasuries than normal, but also generally to US fixed income. We're also underweight US investment grade corporate bonds, preferring European investment grade corporate bonds, while our allocation to higher yielding, riskier bonds is more moderate. We're neutral. We want to have some exposure to that. The yield is attractive, but we want to make sure that we size that position appropriately in portfolios and don't take material risk in that area.
There is a lot of buzz about alternatives, private markets, hedge funds, real assets. Do they really help enhance returns or manage risk in this kind of environment?
So alternatives, that's a very important area, and we have been doing quite a lot of research in that area. It's also a very heterogeneous asset class. You can count on liquid hedge funds as alternatives, private markets, private equity, private credit. You can think of real assets, infrastructure, real estate as alternatives as well. So it's very, very heterogeneous. So what we have done at Quintet, in cooperation with BlackRock, we look at alternatives in a very different way. Rather than just a series of transactions, one after the other, we look at private markets as an example as part of a whole portfolio. So we think about asset allocation across liquid assets, publicly traded assets, and private markets as one single asset allocation, and we optimize portfolios based on that. Can that help enhance returns? We think so. They are very good long-term diversifiers. They can help mitigate risks and also get access to different return drivers such as liquidity, such as innovation at an earlier stage, and we want to capture all those risk premium, which is a fancy word just to say we want to capture those alternative sources of return by our alternative strategies.
Daniele, it has been a real privilege having you with us, and most of all, thanks for helping us rethink how we approach emerging trends.
Thank you, Vincenzo. The pleasure was mine. Thanks also LFMA, and on behalf of Quintet, much appreciated the opportunity.
And for those of you watching us online, stay tuned for the second episode of Spot and Forward on debunking investments with Daniele Antonucci.